So, good morning, good afternoon, good evening to all of you, and welcome to the first of two IBOR transition virtual client webinars being hosted by Standard Chartered Bank this month. Today, we'll provide you with an update on the progress made thus far on the transition away from LIBOR to alternative risk-free rates or RFRs. We'll also talk you through some of the milestones expected as we approach the looming deadline of December 2021. We thank you for joining us today, particularly during these unprecedented and uncertain times. The next slide, thanks, Joe. My name is Kalani Rambaltek, and I'm from the IBOR Transition Program. Joining me on the call today is Ryan Go from our rates trading team, Arpit Mehrotra from the IBOR Transition Program, and Tia Piaupua from our compliance team. Before we begin, a few housekeeping points. As we are using Blue Jeans events to run this briefing session, we will be sharing the slides on screen, as you hopefully are seeing in front of you, and all attendees will be placed on mute. If you have any trouble viewing the slides, please use the move the slider bar or expand the screen. Both of these functions are found at the bottom of your screen. Please note that this is a client-facing session. Throughout the presentation, you may post your questions in the Q&A panel on the right of your screen, and our panelists will pick it up through the course of the presentation, and some will be addressed at the end, time permitting. If we do not get to your question, please be assured that we'll follow up with you after the presentation. So it is important that you sign in with your full name and details so we can reach out to you. Later this week, we'll be sending you the link to the website where you can access these slides as well as a recording of today's session. Next slide, thanks, Joe. So there are two main reasons that we're running these briefing sessions. Firstly, we would like to share an update on regulatory and industry working group developments as we progress in this transition away from LIBOR or the London Interbank Offered Rate. We will walk you through the latest industry updates in the loans, bonds, and derivatives markets, and we'll provide you with an update on the development of RFRs and, of course, what our bank's capabilities are in the RFR space. We'll talk through the latest stance as well on forward-looking RFRs. You can also expect to get an understanding of the important elements you need to consider in your transition planning and what our next steps are to engage with you as we move into 2021. And finally, we'll do a quick run through of a readiness checklist that we've prepared for clients, along with a few tips to prepare for this transition. Next slide, thanks, Joe. So while it's important to understand the milestones that are coming between now and the end of 2021, it is worth recapping some of the more important ones that have led us to the point. It was in July 2017 that the FCA's Andrew Bailey first announced that they being the FCA, will no longer compel panel banks to submit LIBOR after December 2021. And later that year, markets were informed, or rather a year later, markets were informed by the regulator that they must end their reliance on LIBOR and prepare to move to a world with alternative risk-free rates or RFRs. So given the current market environment and the impact of COVID-19, a common question we're hearing from our clients is whether December 2021 is still the deadline for LIBOR transition, and the answer is certainly yes. Earlier in March this year, the FCA, the Bank of England, and members of the Working Group on Sterling Risk-Free Rates issued a joint statement on the impact of the coronavirus on firms' LIBOR transition plans over the coming months. And I quote, "The central assumption that firms cannot rely on LIBOR being published after the end of 2021 has not changed and should remain the target date for all firms to meet. The transition from LIBOR remains an essential task that will strengthen the global financial system." Unquote. A few months later, the Financial Stability Board reminded markets that firms should continue to ensure that their transition programs enable them to transition to LIBOR alternatives before the end of next year. So while there may be changes in timings of intermediate steps to support the transition, the focus should very much remain on December 2021 as the end date for LIBOR. And in 2020 thus far has seen some major developments to assist in the transition. We've had SOFR and SONIA indices being published officially. We've had industry fallbacks being released for the use in Libel link contracts, and we'll look at a few more of what's coming up for the rest of this year, but also into Q1 and Q2 of next year. On the next slide. Thanks, Joe. So looking at the transition timeline on this slide, there are quite a few milestones here, but this quarter has been particularly busy already. Firstly, as part of the global industry efforts around benchmark reform, most systemic central clearing counterparties or CCPs clearing houses such as LCH or the Chicago Mercantile Exchange, they have switched price-aligned interest and discounting. So for all cleared euro-denominated products, the switch from Ionia to Ester took place on the 27th of July, and most recently, around mid-October, the discounting switch took place from Fed funds to SOFR, or the secured overnight financing rate. And this has been effective since the 19th of October. For the derivatives market, a much-awaited announcement from the International Swaps and Derivatives Association, or ISDA, was made late October, giving this direction to the derivatives market participants and making this transition from LIBOR that much more facilitated. On the 25th of October, ISDA published the IBOR fallback supplement to the 2006 ISDA definitions and the ISDA 2020 IBOR fallbacks protocol. And these are to implement the new fallbacks for new and existing derivatives contracts. The supplement and the protocol will take effect on the 25th of January 2021, and Ryan Goh will elaborate a little further on this announcement in his slides on the derivatives market. It's important to note that regulators globally have strongly encouraged adherence to the protocol, and Standard Chartered has certainly adhered. Finally, in the next few months, there'll be much activity to meet two milestones in particular. The ARC, or the Alternative Risk Rates Committee, which is the body that guides the transition from US dollar LIBOR to SOFR, they do expect that market participants will stop offering new US dollar LIBOR derivatives by Q2 of next year. And similarly, the Bank of England has expectations that participants stop or rather reduce their GBP LIBOR stock by Q1 of next year. And finally, there is a significant target cessation that's been announced around issuing new GBP LIBOR non-linear and cross-currency derivatives. This cessation is expected to take place by Q3 of next year. So all of these milestones will require that you firstly that you understand them and what it means for you, and determine how these milestones may impact your portfolio, and importantly, how you can prepare for them now rather than leaving it to a later date. So the next few slides will be providing a high-level overview of and key updates across three markets, so namely the loans, bonds, and derivatives market. So in the loans world, the development of LIBOR fallbacks and new RFR documentation has been somewhat fragmented as compared to, let's say, derivatives, for example. The fact that the developments are being led at a currency and jurisdictional level has also added to the complexity, because we now have different currencies progressing at different rates. So it's certainly something to be aware of when clients have existing multi-currency facilities or are planning to enter into such a multi-currency facility, for example. So what are some of the key updates that we're seeing in the loan space? In the loans market, the Alternative Reference Rates Committee, or the ARC, has published fallback language for newly originated US dollar LIBOR bilateral business loans. So the ARC has also published a technical reference document for syndicated loan conventions, and more recently, the LMA published an exposure draft to help in incorporating pre-agreed conversion terms for multi-currency loan transactions. The Sterling RFR Working Group has also provided recommendations on the credit adjustment spread methodology for fallbacks in cash products, and they have published a paper on active transition of GBP LIBOR loans. And the links are provided on these slides, and you will receive a copy of this presentation later this week. So with all of these developments in recent months, what can you expect from us? The bank will be reaching out to you, our clients, with those especially with LIBOR-linked loans, to communicate the next steps in transition options. RMs are currently undertaking an exercise which commenced last month, where they are contacting all our borrowing clients and having these so-called pre-repricing discussions. It's to gauge client awareness, preparation, and readiness to transact into RFRs. And we will keep you informed throughout this process and provide updates in relation to further market developments in the loan space. If you've not heard from your RM on this, please do email the program and we will follow up on next steps. In terms of new RFR loans, whilst it's comparatively slower in loans markets than in the derivatives and bonds markets, several RFR-based loans have been transacted, and Arpit will speak a bit more on this later. Transition to alternative reference rates is very much underway, particularly in the GP LIBOR loan market. There have been borrowers entering into bilateral SONIA reference loans. There's also been activity in the syndicated loan market, with British American Tobacco entering into a multi-currency facility agreement. And this was an inward switch from GBP LIBOR and US dollar to SONIA and SOFR. And there's been also a sterling facility agreement provided with an inbuilt GBP to SONIA switch as well. So these transactions do show that there's an appetite to start transitioning away from GBP LIBOR now, and it's a helpful path for borrowers and lenders to consider in their plans as well. The bank, Standard Chartered Bank, does currently have capabilities to transact in new RFR-linked loans, and we continue to enhance our systems to further expand the loan product offerings. We have completed the first phase of enhancements with our internal loan booking system, and this enables us to support the booking of bilateral and syndicated loans where the bank is not an agent. So you can always reach out to your RM to find out more and what is actually happening in your jurisdiction in particular. Thanks, Joe. The next slide. So similar to the loans market, the developments across the bonds market has been led by different working groups and industry bodies. In relation to fallbacks, the International Capital Market Association, or ICMA, has published a guide to the transition to risk-free rates in the international bond market. This guide contains information on conventions and fallbacks and spread adjustments, etc. Additionally, the ARC has also published recommendations on more robust fallback languages for new issuances of US dollar, LIBOR, floating rate notes, and securitization. So the bank does expect to reach out to our clients with LIBOR-linked bonds in early 2021 to communicate the next steps and also transition options, and we'll keep you informed about this process as well. In relation to new RFR bonds have been issued in the market, and it appears that the SONIA bond market is quite advanced compared to other RFRs. New GBP SONIA bonds have been issued, along with a number of consensus solicitations to convert GBP LIBOR bonds to SONIA. There's also been an increase in the issuance of US dollar SOFR bonds. Not exactly bad news there, but there are some challenges. However, the market conventions for RFR bonds are still very much in development, such as look back, payment delay, lockout, etc. And currently, the bank does have capabilities to offer RFR-linked bonds and is able to support the issuance of RFR-linked bonds based on our clients' needs. So reach out to your RM if you'd like to find out more in this space. In terms of offering LIBOR bonds maturing beyond 2021, the ARC is recommending for this to cease by the end of this year. And the RFR working group has also indicated that GBP LIBOR bond transition has largely been completed. There has been a significant volume of new SOFR and SONIA-linked FRNs issued since mid of last year, and so far these have been issued by sovereigns or supranationals or financial institutions. Public issuance of GBP LIBOR-linked FRNs with a maturity beyond 2021 has all but ceased. RFR-linked issuances by corporates is expected to pick up, certainly in the coming months, alongside the broader transition of corporate debt products to RFRs. For Standard Chartered and Standard Chartered issued bonds and structured notes that are impacted by the discontinuation, as I mentioned, we'll be reaching out to our investors over the next months. I will now pass you on to Ryan Go from the rates trading team, and Ryan will talk you through the next section on the development in the derivatives market. Ryan?
Thank you, Kamini. So in this slide, we will talk on the some of the key developments and updates from the derivatives market. Now, the month of October marks a significant milestone in the IBOR transition progress, especially with ISDA launching the ISDA protocol, as well as the amendments to the 2006 ISDA definitions. Now, this document has been a work in progress involving multiple industry participants and gone through a variety of feedback and consultations. A key point of this would be to look at how legacy derivative contracts should behave once LIBOR ceases to exist. Now, it's imperative to note that the existing 2006 ISDA definitions can only cater for a temporary cessation of LIBOR, perhaps due to a market disruption event of sorts, and not a permanent one. As a brief recap, LIBOR will fall back to compounded risk-free rates, also known as RFR, plus a spread adjustment. Now, this spread adjustment is necessary to account for the credit and term premium that is present in LIBOR, but not the risk-free rates. The industry body has essentially voted for a 5-year median look-back approach for this computation of the spread adjustment. Now, using $3 months LIBOR as an example, upon LIBOR cessation, we'll look back over 5 years of data, and for each day, we'll compute the spread between USD 3 months LIBOR as well as compounded SOFR over 3 months. The median will then be computed, and that will be used as a spread adjustment henceforth. Now, we'll start to reach out to clients to understand their positions with regards to the protocol adherence, and we'll look to begin conversations on this soon. It is also worth noting that ISDA targets January 2021 as the effective date for the supplements and the protocol. So that gives us roughly about 2 months for discussions and to understand things from a systems perspective, as well as how to manage one's derivative exposure. Now, before we embark onto the next slide, where we'll touch on liquidity in the risk-free rates markets, I would also like to highlight 2 key dates. The first is that by Q1 2021, there is an expectation for market participants quoting and transacting derivatives that we should no longer suggest any pricing or liquidity around sterling LIBOR. Now, the corresponding target for US dollar LIBOR derivatives is by Q2 2021. Now, these targets will come swiftly as we move into the next year, and we'll continue to monitor and provide updates with regard to the liquidity of the risk-free rate markets. Can we move to the next slide, please, Joe? Now, as we mentioned in the previous slide, the month for October is an important one for IBOR transition, especially since clearinghouses have transitioned from using Fed funds for the price alignment interest or discounting to SOFR for cleared dollar derivatives. Now, the discounting switch from Fed funds to SOFR, as well as the concomitant auctions for the SOFR Fed funds basis swaps, has resulted in a significant increase in SOFR trade counts, as well as volumes for the month of October. And these volumes are roughly 4 to 5 times the monthly average, as the chart on the left shows. Nonetheless, there are some marked differences in what we are seeing now in terms of liquidity of the risk-free rate markets across the 3 currencies, so namely sterling for SONIA, dollars for SOFR, and euros for ESTA. Now, the chart on the left illustrates the trade count and notional differences between SONIA, SOFR, and ESTA, with SONIA notional and trade count dominating over the other 2 marketplaces, even though the UK derivatives market is smaller than its US and European counterparts. The ratio for SONIA versus sterling LIBOR derivatives volume, that's in SONIA volumes versus sterling LIBOR derivatives volume, is roughly now at 50% each. And this is considerable picked up from last year, where the ratio was roughly 30% SONIA and 70% sterling LIBOR. Now, looking at SOFR, this ratio is much smaller, and it stands currently roughly at less than 2% of the total US derivatives market now. However, the discounting switch, as what we mentioned previously, for cleared US dollar derivatives at clearinghouses should provide a positive catalyst to engender higher risk-free rates derivatives volume moving forward. Finally, the chart on the right illustrates risk-free rates volumes for issuances. And in this regard, SOFR clearly dominates SONIA and ESTA, and this more accurately represents the relative sizes of the US market relative to the UK and the Eurozone. It also suggests increased investor confidence with risk-free rate adoption in the floating rate space, as SOFR gradually becomes a replacement for the US dollar benchmark, US dollar LIBOR benchmark. Can we move on to the next slide, please, Joe? I would like to conclude my portion with a discussion of the bank's capabilities in the risk-free rates derivative space. Now, in the G5, that is the United States, UK, Europe, Japan, and Switzerland, Standard Chartered is able to offer linear derivatives both as an outright, in other words, fixed versus compounded risk-free rates as a floating index, as well as basis swaps, which means compounded risk-free rates versus the corresponding IBOR. The tenor limits are adjusted depending on the liquidity of the risk-free rates markets, and we offer up to 30 years in most markets, with the exception of Switzerland and Singapore. Now, speaking of Singapore, we offer SORA derivatives. SORA is actually the replacement benchmark for SOR. We offer SORA derivatives up to 10 years. Volumes are increasingly slowly, but we are seeing good support from the regulator, in this case the MAS or the Monetary Authority of Singapore, to grow their market accordingly. Finally, as a bank, Standard Chartered have recently participated in two of the world's first cross-currency basis swaps, the first being SOFR versus China 7-day repo rate, as well as SOFR versus LIBOR, which is the Malaysia benchmark. The cross-currency swaps market is still developing slower than what we would like, but we'll most likely see a pickup going into next year when the CSA starts converting from Fed funds to SOFR, together with increased market confidence in the risk-free rates. So on our end, we'll monitor the situation closely and provide updates where there are notable developments with regards to liquidity in the risk-free rate space. Thank you, and I'll now pass my time on to Arpit, who will discuss more about risk-free rates in the loans.
Thank you, Ryan. So adoption of RFR rates have posed varying degree of challenges for all asset classes, and Ryan earlier touched on some of the challenges in derivative markets like lack of liquidity and low volumes, etc. The challenge in the loan markets is slightly different. Loan market was heavily reliant on the LIBOR term structures, and now it has to switch to an overnight RFR rate. To overcome the non-availability of a forward-looking term structure, a number of new alternative methodologies have emerged in this space. In the next couple of slides, we'll cover these RFR-linked interest calculation methodologies and conventions. Let's look at the RFR interest calculation methodologies first. We have a couple of options right now, and they are compounding interest and simple interest. As the naming convention suggests, compounding involves compounding of RFR rate over the relevant observation period, while on the other hand, simple interest is simple arithmetic mean of daily RFR published. There are broadly four distinct conventions, as can be seen on the slide, and these are lag or look back, lockout with true up, delayed billing, and lockout with no true up. The notes on the side describes each of these interest computation methods in details. But to understand these methodologies in details, we'll take help of a chart that's included on the next slide. Thank you. On the slide, each of the four methods of RFR interest calculation is graphically shown. To understand these methods, let's consider an example of a term loan, which is drawn 1st January 2021, and where the interest is settled on a quarterly basis. We'll start with the base case scenario. That's the first scenario on top of your screen. In base case, the observation period is identical to the interest period. That is, the loan will be disbursed on the start of the period on 1st January 2021, and the interest will be due on the last day of the period, which is 31st of March. But given the publication time of most RFR, this method has a disadvantage. It requires a payment on the same day that the final payment amount is known. In our example, that day will be on 31st of March 2021. And as a result, it makes it impractical for use. Like I discussed earlier, we have four different pricing methodologies which are available to us. So let's just go through them one by one. First one is lockout. In this option, RFR is no longer updated. It's frozen for a certain number of days prior to the end of the interest period. In our example, the lockout period is between 25th of March to 31st of March. This is highlighted in orange on our chart. During this time, the RFR of the day prior to the start of the lockout period, that is of 25th of March, is applied for the remaining days of the interest period. And as a result, the RFR rate to be settled can be calculated before the end of the interest period. The next methodology is lockout with true-up. As the naming convention suggests, this option behaves in the identical manner to lockout method discussed earlier. The only difference is that any interest rate differential between the actual rate for the lockout period and the frozen rate is trued up in the next interest rate cycle. This is shown in a chart in a darker shade of blue. Third option, which we have, is a payment delay. So in contrast to the base case, the interest payment in this methodology is delayed by a certain number of days and are thus due few days after the end of interest period. In our example, the interest accrued for 3 months ending 31st of March 2021 will be cash settled on 4th of April. Lastly, fourth method is look back. In contrast to the base case, the observation period for the interest rate calculation starts and ends a certain number of days prior to the interest period. In our example, the observation period will start on 25th December 2020 and will end on 25th of March 2021. As a result, the interest payment can be calculated prior to the end of interest period. Based on the latest developments, a forward-looking term rate for SONIA is likely to be made available by the beginning of next year, followed by SOFR by the middle of next year. Such term structures will follow interest calculation methodologies, which is similar to LIBOR. My colleague Tekpia will discuss that in following slides in a bit more details. Moving on to the next slide, please. So this slide covers the Standard Chartered capabilities for lending products. At present, as can be seen on the screen, we can offer bilateral and syndicated term loan facilities referencing SONIA, SOFR, and ESTR across 7 different markets, which are US, Singapore, UK, Hong Kong, Taiwan, and UAE DIFC. If you have any other RFR loan requirement in a location other than the 7 listed on the screen, we can take a look at it on case-by-case basis. What's coming next? By Q1 next year, we are also targeting to offer syndicated loans as an agent bank and add to the booking locations we are currently offering the loan facilities in. For the trade products, which are shorter dated in nature, i.e. maturing within 6 months, the current LIBOR pricing will continue to apply. But for longer dated trade products, we'll be able to offer RFR pricing. However, that will require some lead time. At this time, let's take a look at what's happening in the loan market in a bit more details. Based on the information which is publicly available and published on the LMA website, there are only a small number of RFR-based loan transactions that have been executed till date. These transactions are mostly using compounded and arrears methodologies of computation of interest, together with a look-back convention. Some of these major deals are done in Europe and are mostly SONIA referencing. Like Kamini mentioned earlier, there is a deal of National Express, which is a SONIA-based bilateral RCF. Again, we have Southwest Water, an amendment to an existing bilateral LIBOR, which is now based on SONIA. Like I highlighted earlier, an extensive list of such deals are available on the LMA website, which you can refer for more details. While these transactions are mostly bilateral in nature, a variant of RFR loan was entered into in December 2019, where Royal Dutch Shell signed a new English law US dollar syndicated revolving credit facility, which initially references LIBOR, but it includes a mechanism whereby at a specified date, the transaction will switch to a compounded SOFR. This is commonly known as a deal with a switch mechanism. A slight variant of Royal Dutch Shell deal was also announced in March this year, where British American Tobacco entered into a multi-currency facility referencing RFRs. But by and large, we have not seen any significant transition away from LIBOR to any other pricing alternative, both in terms of pricing methodology and the interest calculation convention. At this stage, I'll pass on to my colleague Ditya, who will tell us a bit more about the forward-looking RFRs. Over to you, Ditya.
Hey, thanks, Arpit. Hi, so this is Chapter here from Standard Chartered. So we are on the slide of forward-looking RFRs. So as you would have heard from my colleagues Ryan and Arpit, for derivatives as well as for cash loans and bonds as well, what's happening now in the RFR world is that for these instruments to essentially, because the RFR, as I think my colleagues have explained, is an overnight rate. So for the RFR to be used in these instruments, it is compounded on a daily basis to, let's say, a month, 3 months, or even 6 months. So this essentially gives a term structure to a RFR. So a 3-month compounded, let's say, SOFR is what is actually being used for, let's say, derivative contracts, and in certain cases, bonds, as well as loans and other financial instruments. So these compounded RFRs are still backward-looking rates, meaning that they are based on actual rates and compounded over the tenor. It is different from a LIBOR, which is what is being used by most of you today, whereby the rate is actually something that is forecast in advance. So I think a lot of clients have asked us, essentially, will there be a forward-looking RFR term rate? And I think the answer that we have right now is maybe. So maybe if I can take a step back, is why would why is there a need for such forward-looking RFR rates? A few reasons, as we've set out here. The first is that in certain instruments and products, the way that they are currently structured, they need a forward-looking term rate. So in the derivatives world, this would be, in the case of a FRA, for example, forward rate agreement, a cap floor, or even range accrual type instruments. So that's in the derivatives world. In parts of the lending world, for example, in Islamic banking, again, the structures of the Islamic facilities do need a forward-looking term rate, and a compounded RFR type term rate doesn't work for such structures. So that's one. The instruments need that. The second, I think, reason why I think a lot of what have asked for forward-looking term rates is, I think, as Arpit mentioned, for a, let's say, a loan product, right now clients have possibly 30 days or more where they know what their interest payment is, and then obviously to arrange for payment of the interest. But with a compounded RFR, clients will usually have much less time, let's say 5 days, before they actually know the interest, because the facility is, the interest is compounded, and then payment date is usually a relatively short period of time. So I think for certain firms, I think they do want a longer period, and they do want that certainty of what their cash flow for the next, let's say, 30 days will be, which is why I think they are also asking for a forward term rate. Then last but not least, there could be certain clients and even certain financial institutions where operationally compounding of a RFR just present technological and operational challenges. So I think that's one reason why I think the industry has been asking for forward-looking term rates. And specifically, the UK Sterling Risk Working Group has identified a segment of the sterling market whereby a forward-looking term rate, a term SONIA rate in the UK might be applicable. So as I've mentioned, as you can see, the fourth bullet point, Islamic banking is definitely one of them. Trade and working capital products, that is also because in some of these trade facilities, the nature of the discounting product needs a forward-looking term rate. For smaller retail clients, again, forward-looking term rate gives clients more time. to know what the interest is, and then to also arrange for their cash flows. So I think that's one reason why I think a lot of clients have asked us, essentially, will there be a This would be for SMEs or even retail clients. So these are, I think, the sub-segment of the market where a forward-looking term rate might be applicable. I think the UK working group did estimate that there are most of about 10% of the market. The remaining 90% of the market is likely to be able to use a composite in arrears type term structure. I think that the challenge right now, I think to the start of my presentation is a maybe, because for a forward-looking term rate to be developed, there is no certainty that such a rate will be developed and will be authorized and approved by the regulators. So for sterling, a forward-looking SONIA, I think, might be available by the end of this year. I think there are beta versions that are already being published, so they do need to get regulatory clearance before they can get, before firms can start looking at how to use them, and also because they would also need to be, I think the industry also will need to look at documentation and other templates as well. So that's for sterling. For a lot of you, right, if I look at dollars, there is a possibility that a forward term rate for dollars, a forward term SOFR, might be available sometime in the first half of next year. There is less certainty here. I think the US authorities have done an RFQ looking for a potential vendor to publish this. So a lot of this forward-looking term rates, the construction of them, again, the methodology would be based on a derivatives, whether it's an OIS product or other derivative products. And I think this is where the liquidity of the underlying derivative market is important, as Brian mentioned earlier. So I think in summary, what we can see for forward-looking term rates is that they might be available, but even if they are available and they are authorized for use by the private sector like ourselves and yourselves, I think the regulator's expectation is that it will only be applicable for us a relatively sort of limited section of products, and generally firms where possible, including banks like ourselves and clients like you, should, where possible, move to a composite in arrears type RFR structure, because it's back to the point that the term forward-looking term rates itself are not a guarantee. It's not confirmed that this will definitely be published, and even if it's published, this will definitely get regulators' approval, and even then, the products themselves in the development, I think all these are, multiple uncertain areas in the sort of path towards a term rate. So I think for yourself, I think what you do need to do right today is to really have a look at your current LIBOR exposure to see which of them does need a forward-looking term rate and can't use a composite RFR in arrears. And this will be, I think, once you have identified these, right, or if you have some questions around them, do reach out to us, and I think we'll be happy to have a discussion around that. Next slide, please, Joe. So the next slide, I think, gives you a good overview of where the different currencies are. As I've mentioned, for US dollars, a forward-looking RFR potentially may come about in the first half of next year. Sterling already has beta version being published, and it is possible that a final version will come about by the end of this year. In Japan, Quick Corp has been appointed as the vendor publisher for a term TONA product that is now, I think, in beta as well, and the expectation is that something more final may come about next year. Europe is slightly slower. I think they are only looking at the process getting more sort of concrete around early next year, which means that a final sort of term version of the Ester might only be available towards the middle or second half of 2021. If any of you are using the Swiss franc, for Switzerland, they have decided that they are not going to develop a forward-looking RFR, terms of SARON, which is this risk-free rate. So clients who have Swiss exposure will need to work on whether they can use a compounded Sauron instead of waiting for IFR. And in fact, I think the overall message is that where possible, clients should not wait for forward-looking term IFRs because, like I said earlier, I think the publication and the authorization of all these forward-looking term IFRs is not a guarantee. And certainly the regulators do encourage firms where possible to use compounded in arrears type mechanisms. Okay, with that, I will hand it back to my colleagues.
Thank you, Tech PR. Thank you very much. We'll move on to the next section. As I mentioned, we have compiled a readiness checklist, which some of you would have received a link to in client outreach emails that were sent out in the last few months. And it brings out a list of readiness items that you should be considering in preparation for the transition away from LIBOR. The actual checklist can be found on our sc.com website, and we will provide the link to that as well in the presentation. So just a quick run through of some of these checklist items. Very important that you constantly update yourselves and understand the developments that are related to the transition. Also very much around you keeping up to date with what our transition updates are, our various communications that we send out, updates that we have on our sc.com website. You should bookmark those pages. By you being at this presentation this evening, that's one way of keeping up to date as well, so that's great. As I mentioned, this is the first of two webinars we're running this week. We'll have another 2 in December, and look at more engagement activities in the new year as well. We do provide here developments from the regulators and industry working groups, so it's a good spot for you to get your updates as well. In terms of understanding what your actual exposure is to LIBOR, you should be assessing the likely impact of this transition on your products and consider seeking independent advice as well where required. You may need to classify your LIBOR-linked transactions by asset class or tenor or maturity, and it's important to identify the exposures that potentially mature beyond the end of 2021. It's also important to consider assessing the potential financial impact where there's possibility of switching and causing some sort of discrepancy in the pricing. On the legal side, it's important that you identify the relevant contractual documentation that has your LIBOR-linked exposures captured, and because these are going to help with the remediation process that we will commence talking to you about early next year. Also consider the implications on the contractual terms, such as triggers and the legal interpretations of fallbacks, etc. As I mentioned, the ISDA did announce its protocol a couple of weeks ago, and if you're adhering to the protocol or considering the adherence, it's important to understand what that means for you, and assess as well the impact on the legal function capacity within your firm. So potentially you may need to upscale resources for the work that's required around, say, contractual remediation, for example. Moving on to the next slide, thanks, Jeff. So on the accounting side, several implications of the transition on accounting standards, as well as the financial and valuation impacts, which could impact your business. So reviewing your LIBOR exposures and hedging relationships with regards to the latest updates from the International Accounting Standards Board. There's been quite a few announcements this year, and also assessing what your fair value changes are or reporting implications, and if there are any credit allowances or losses that need to be considered. Another consideration could be to identify what the potential tax implications are, which may arise due to the modification of your contracts to a new RFR-based contract, if that is how you would like to proceed. Again, it's important here to engage independent consultants to understand what the financial reporting and taxation implications might be. On the operational side, there could potentially be quite a lot to do in terms of preparing your systems and systems that may be linked to LIBOR, which include, financial reporting ledgers or payments and settlement systems. You should also identify any manual spreadsheets and documentation that may use LIBOR as an input, and consider developing or ensuring that all your systems and processes are changed and ready to transact in RFRs when the time is there. On the documentation side, you could identify what your bespoke LIBOR contracts should look like, and which could prove to be, some of them may prove to be difficult to transition to or modify their existing contractual terms. And finally, assess the need for updating any existing documentation, such as broader policies and procedures within your organization. Next slide, thanks. Here are a few points on identifying what the key risks are against your current risk framework, establishing processes to monitor and mitigate any transition risks. Also, the transferring of RFR products. Consider assessing what the suitability of the RFR suite is for your requirements and your needs. We'll be presenting you with all our options, and it's for you to decide what the next steps would be. And finally, communicating with your stakeholders around the different aspects of the transition. This is key to managing the impact. Constantly reviewing and refining your transition plans to engage with your external vendors or your employees. This is meant to be quite an important step as well in your transition planning. On to the next slide. Thanks, Joe. So as I mentioned, we are undertaking quite a few client outreach campaigns. There is one currently underway when your RM will be reaching out to you between now and the end of this month to talk to you in what we're calling pre-repricing conversations, so ahead of next year's remediation activities. You should hear from your relevant RM if you are a borrowing client. We have established this global IBOR transition program, and we're ensuring that all aspects of the transition are being considered and appropriately mitigated. We're monitoring ongoing developments across the various industry bodies such as ISDA, ARC, LMA, etc. And we're ensuring that everyone at the bank understands the importance of the transition. So our relationship managers, our frontline teams, our middle office teams, etc. And we, as I mentioned, or as Brian and Arpit and Tepia have walked you through, we are very much enhancing our RFR capabilities and developing these on an ongoing basis. So a few tips on this slide on the next steps for you. As I mentioned, we went through the checklist, and that is readily available on our external site, along with a few other informational brochures which you can download easily and readily. We will be providing this slide deck to you, and you'll be able to have access to all the links that are in this document. Can we just move on to the next slide? Thanks, Joe. You will receive this slide as well, which has a link to all the various resources that we might have mentioned throughout this presentation. We've got about 10 minutes left, so I wanted to turn to some of the questions that you all may have, and some of them have been answered directly in here, but for those of you who have not been able to look through, we might just walk our way through some of them around. So we had a question from someone, if I just go to the bottom, around the different calculation processes for RFRs, from someone that is anonymous on here. ARPA did speak through a few of those, and hopefully that's answered your question. We did have a question here as well from Jeremy on the swap market and the term structure of these RFRs. On the swap market, Ryan, did you want to make any commentary on that for Jeremy Citrook's question?
Yeah, sure, Kamini. And thanks, Jeremy, for this question down here. So in a way, the term structure of, basis swap markets, so for instance, like 3 months dollar LIBOR versus compounded SOFR over 3 months, they have kind of adjusted to reflect, the ISDA fallback calculation methodology. And what do we mean by that? So if, for example, we consider a 10-year SOFR LIBOR basis swap, and you compare it with like a 15-year, 20-year, 25-year SOFR LIBOR basis swap, you realize that the term structure is almost like a flat line. And this is really reflecting the market's way of interpreting the ISDA's fallback methodology, where 3 months dollar LIBOR will fall back to compounded SOFR over 3 months, plus the same spread adjustments that will be applied henceforth, for the rest of the life of the derivative. So currently the term structure is flat-lined to around like 22 to 26 basis points thereabouts. And, this is really the market's way of reflecting, the ISDA fallback methodology.
Thank you, Ryan. Jeremy, hopefully that has answered your question. But if you had a follow-up, you're welcome to send us a note at ibor.transition@sc.com. In fact, if any of you have follow-up questions, please do email our central team and we'll pick it up from there. Shaheen, you've asked for the presentation as well, and you've had a couple of questions around the backward-looking rates, etc. Hopefully, we've addressed those for you as Arpit was talking through some of the methodologies for the loans section. We did have another question around trade financing. How about the impact on the pricing of trade financing, in particular, supplier financing programs? Now, we don't have anyone from our trade team on tonight, but Arpit, I just wanted to check if you wanted to make any commentary on this, and we could follow up with this person as well. Or if they could follow up with us and write us an email, that would be great, and we can address their questions further. Arpit, if you're on the line?
Yeah, Kamini, that's fine. I think it's a very valid question for the trade facilities. And this is something which is also discussed at the recent ICC, which is International Chamber of Commerce IBOR Working Group meeting. A white paper was presented at this meeting, which highlighted the dependency on a term structure for these trade facilities. And in absence of a term structure, some alternative pricing methodologies were also discussed that could be used by financial institutions in case there is a delay in finalizing or publishing for the RFR term rate. And I think these methodologies of pricing are somewhat similar to what's being used in the loan markets. They've been prescribed as using overnight RFR rates or use a different benchmark rate altogether, like a policy rate, which is linked to a Fed fund rate, a Bank of England rate, prime rate, etc. for pricing. ICC clearly highlighted that any such alternate which might be used is merely interim, and it could create pricing mismatches for the borrower and which system enhancements and additional investment costs. As a result, the working group recommended a firm roadmap with clear dates for publication of term risk-free rates to allow for associated time and efforts required by both clients and financial institutions in changing their system procedure and legal agreements, etc. So I guess the point is there is a huge dependency. Everybody understands that. It's being discussed at the moment, and they are sticking to it that a term rate will be published in near future. So from Standard Chartered point of view, and I think we have highlighted this on slide number 12 of the presentation, that the trade facilities which are shorter dated in nature, we'll continue to price them on LIBOR for the time being. So I think we're watching this space, a valid question, but for the time being, we're sticking to LIBOR for such facilities. Hopefully that answers.
Thank you, Arpit. I have also, it's come from someone that's anonymous, so I have posted our email address there. So hopefully if there are any follow-up questions on this important topic, then please do email us and we can address it directly with you. We do have a question from someone on the SORA space. So this is a very Singapore-centric question around, will SORA loans be available before the cessation dates in April? So we did have an announcement a couple of weeks ago from our Singapore regulators giving some new milestones around cessation of SOR-linked products. To answer your question, we are constantly building our RFR product capabilities, and certainly for, sorry, could someone go on mute? And certainly to build our capabilities in the SORA loan space, we should have an update around this specific class of products in Q1 of 2021. But if you would like to transact in a SORA loan now, then contact your RM or email us, and we can speak with you directly on how this can be how we can execute a SORA loan today. We did have a question, and Mr. M.M. Shaheen, you've requested for the slides that we've gone through today. As I mentioned, it's going to be emailed to all of you, even for our colleagues who were unable to join but did register for today's session. You will also receive the slides and a link to the recording for today's session. We do have a question from someone around Islamic banking products, and particularly derivatives. You're correct. It's also, again, from an anonymous person, but the question was around how do we actually manage these Islamic derivatives products, given that they're not in scope for the ISDA protocol. Definitely would need to involve bilateral discussions and fallbacks that will need to be included, but there's still quite a lot of discussion in the industry and among the Sharia scholars around how this is going to be managed. So if you'd like more information on this, please do contact us and we can give you a bit more guidance specifically around your products that you have with us. But there are quite a few industry forums that are taking place in the next weeks, and that's hopefully going to give some direction around how these different asset classes are going to be managed in the world of Islamic banking. We did have another question. It's Taib Lubega. For my borrowing from other multilateral lenders priced at 6 months LIBOR plus BPS, does it mean that my lines of credit will now reference SOFR and a spread adjustment and then the spread over and above LIBOR? This is around the slides that Arpit had talked through around how we will be actually structuring the RFRs and how that might look. Arpit, do you want to add anything to this question around moving from LIBOR to and plus the basis points to SOFR plus a spread adjustment? I'm not sure if we still have Arpit on the line.
Yeah.
Oh, yes.
Can we come back to a later point?
Yeah, sure. We're looking at any more questions that we may have. We seem to have addressed all of them. If there are any follow-up questions, can you please just reach out to the central team, and we'll definitely be able to connect back with you on any follow-ups you have. Any more questions, please do post it in this Q&A panel. We have a minute or two left. I think just in the interest of time here, I might say, so Taib, we will follow up with you as well. We'll connect you with someone from our business teams that can explain this a little bit more and give you a bit more flavor and discussion around, and have a discussion with you around it. As I mentioned, you'll get the slides, all the links on these of what you're seeing in front of you as well. You'll have access to. If we are having a second session on Thursday this week, at 5 p.m. Singapore time. These details can be found on the sc.com website, and there will be another 2 in December as well. So depending on various milestones, we update these slides, but it is something that we are continuing to run because we do have certainly requests from clients to run these generic sessions. If you want more product-specific discussions, definitely something that you would need to engage your RM for, and we can arrange for calls with product specialists and very different subject matter experts if that is what you are looking to do as well. So we have reached the end of the hour. As I said, thank you so much for joining today's session, and any questions, do email the team. Thanks and have a good day.